Welcome to Benny and the Squirrel. It is April 16th. We're joined by Craig Shapiro, the macro strategist from Ninja Trader. Craig's been in a lot of hedge funds over the day. He's been on the street about as long as I have, or maybe a little longer. And he is coming to you today to talk about these crazy markets in April. Welcome, Craig.
How's it going, guys? Glad to be here.
Thanks for coming, Craig.
Absolutely.
So, Craig, let's just start it off with you had written a piece for your subscribers about this Hormuz throttle, which, let me just preface this, because the markets rallied, somehow everyone just thinks it's all over, but then we'll get to it, but it doesn't seem like it's over, does it?
Yeah. I wrote this a few weeks ago, trying to understand the game theory here between the US side and the Iran side and kind of what was going to ultimately play out. And for Iran, Hormuz has become, the biggest thing, right? This is their ability to slow down the global economy. This is their way to fight against the West. They understand that, they understand the Trump tacos. They know financial market assets are the Achilles heel for the administration. They know they can't beat the U.S. in a war that's purely military, and so they need to figure out other ways to fight. And their staying power is more resolve than the president does. And so, because financial asset prices are things that he cannot tolerate going lower, so the combination of lower stocks, lower bonds, and higher oil is the president's Achilles heel. So if Iran can figure out a way to keep that dynamic in play, then they're more likely to achieve a ceasefire, a stalemate, and a continuation of their ability to rule and exist. And so the Strait of Hormuz is their choke point, right? They're able to control the speed of the global economy by slowing down ships, allowing certain ships to go through or not, allowing certain types of products to go through or not. And this is their way to slow everybody else down, put strain on the West, put strain on Asia, Japan, Korea, put strain on Europe, put strain on the U.S. allies in a way to prevent them from and their regime from being eradicated. And so that was kind of the dynamic here. And my thought was that they were never going to easily agree to reopen the strait without, just because the president asked them to. And so that's kind of the dynamic that we're in here. Yet financial markets have, just moved so rapidly from the lows back to the highs again. And, the impact of keeping the strait closed now for 6+ weeks and the likelihood that it's going to stay, largely closed for the next several weeks doesn't appear to be at all being priced into financial markets anymore. It was a few weeks ago for sure, but now we've moved on, or it seems, and the markets are no longer concerned to a large degree. Certainly, equity markets. The bond market is seeing higher yields than pre-war. Interest rate cuts have modestly been removed from the U.S. curve. Oil certainly is higher than it was pre-war. Many commodities remain higher than pre-war. Yet risk assets are generally higher too. So kind of an interesting timing here after a big move here, and just as we kind of approach the weekend and this April 21st ceasefire deadline, we'll see. There were some comments out today, and you have them up there, that European leaders and Gulf leaders are thinking that it's going to take at least 6 months to come to a resolution. But when you listen to the president, a deal is happening imminently, because he continuously talks up the financial markets, because he knows that's his Achilles heel. So as long as he can keep vol suppressed, he holds on, and things look better. So I don't know. I think Iran's going to hold on tight here to make sure that they get what they're looking for out of these negotiations and ceasefire, and they're going to use the control over the strait as the primary vehicle to achieve those end results.
I know we're going to talk about equity market structure later on, Craig. But why do you think that the paper crude market is not responding to the realities of where physical barrels are trading in certain parts of the world? I understand why other financial assets have other things sort of moving them around, largely flows, largely impact from option markets. But for me, the front month crude price just is not But it's not pricing where the physical world is.
Yeah. Again, I think it's I think it has a lot to do with the flows and a lot to do with like who buys front month crude, versus history, historically. I think, the users of crude, I don't think are hedging as much, anymore using futures. They're just kind of, they're buying physical barrels at the prices they are. Many of the, let's say the airlines, for instance, have eliminated any of their hedging programs, over the course of the last several years. So they're just kind of, in there buying spot where whatever the prices are for jet fuel. And I think financial players who normally would trade these markets have just been, they've been blown up, right? We've had a rolling cascade of various, blow off tops over the course of the last several, months and quarters, whether it was the rare earths and uranium names at the end of last year, it was precious metals earlier this year, then it became oil, earlier, in March. And I think hedge funds are just, are exhausted. They're losing money other places, and they're having trouble really stepping in and kind of owning front month crude here. And maybe it's just a lack of, a lack of players who are in these markets. And so I think that's part of it. And I think what you're seeing is the strength in the physical market kind of reflects that economic reality. And so you have this paper versus physical, divergence, which, many people have never really seen before. And so I don't know. I think that's part of it. And look, the volatility of oil has been kind of crazy. You see these gap ups, gap downs, movements, $10, $20 in a day. Who could stick with that overnight risk? Who has the ability to trade that and to stomach those, that P&L? You can imagine the risk managers are just forcing people to play smaller, in order to tolerate that volatility. So I think that's the large dynamic in play there. You look at deferred crude. December 26 crude is, is closer to the high than not, right? So, yeah. Where it's more likely to see a fundamental player or a physical player engage, further out the curve, I think you're seeing a little bit more of the reality. But yeah, I think front month, it's become a casino.
Yeah, the trouble is that front month is the kind of pricing input for other risk financial assets, right? And so this is sort of, if you like, sort of, lobotomizing is the wrong word, but it's certainly sort of dulling the senses of other risk asset markets, perhaps.
I totally agree. The course of the last, few weeks, I think is indicative of that, right? We've seen this V-shaped equity market risk on bounce on back of, a reduction in the probability that the end of the world was coming. So, if we want to take the probability of World War III from 5% to, less than 1%, that's good for a decent bounce in risk. But, subsequent to that, we still have an environment where the supply chain is restricted. We have had inventories being released globally from the SPRs, from, tertiary stocks to kind of offset the immediate impact of where prices are. But, there was a headline out this morning from Europe that they're 6 weeks away from having no jet fuel, right? Well, if Europe is 6 weeks away from having no jet fuel and it's going to take 6 months in order to get this, a deal with Iran closed down, and they have a massive timing mismatch in Europe. So I think as we push through the end of this month and into next month, we're going to start to see more fundamental physical complaining about access to raw materials, access to supply. What are companies going to be doing about it? They're going to be reporting earnings, they're going to be reporting outlooks, and having to talk down. I think that's an environment where you're more likely to see risk assets correct to what the economic reality is. I think that divergence between paper and physical now is about as wide as I can remember ever seeing it.
You said something about in your paper about you'd estimated the amount of barrels that got hit by the refineries, right? So it's one thing to get the boats flowing, or sailing again, or whatever, boat, floating and moving, but and I know Iraq's trucking some oil, and they're there's guys trying to do stuff. But Rupert's second largest refinery down there in Australia just got
second largest. We only have two. And one blew up the night before last.
Yeah, and we saw a lot in the Middle East. So, how much did you estimate that was? And those don't just come back online quite as quick as boats floating.
No, look, it seemed like I saw something on X earlier today about the number of refineries that have had mysterious fires over the course of the last 2 months. It's shocking. There's no such thing as coincidences, I guess, right?
Well, except that the coincidence is that crack spreads have been phenomenally good.
And they're running hot. They're all running hard. They're trying to get as much.
They're delaying maintenance, and accidents happen. There's a reason why you fix this stuff and maintain this stuff, because this is what happens when you don't.
Yeah.
Right.
Oh, yeah, for sure.
Yeah.
I the conspiracy side, this is what happened in refineries sometimes.
Yeah. I think at the early onset of this, there, fundamental analysts and market participants were trying to do the math, trying to do the work, and saying, okay, what does this mean? How many barrels upstream, downstream? And then, over the course of the last couple of weeks in this rally higher, it just seems like we've thrown there's been no analysis going on, right? No one has really.
To be honest, I mean, I've seen the oil specialists, people like Rory Johnson, right? Pretty very, very calm demeanor, sort of classic calm Canadian, and he's ringing the 5-alarm fire bell, right? And that makes me sit up and take notice, because that is not what he's wont to do. And everyone's ignoring the energy specialists at the moment, it seems.
Yeah, no, I mean, because the president, has the bully pulpit, I think, and he continues to, push down volatility in a way that makes it harder to hold on to positions that are anti what he desires, which is lower oil price, higher equity prices, lower bond yields, weaker dollar, right? And so you're fighting this human VVIX machine who can tweet and talk whenever he wants. And it makes, trading against him difficult, and certainly makes it difficult to trade against him in periods during the month and the quarter where there are supportive flows in options expiry, right? So we saw that for the JP Morgan collar strike at the end of the quarter, aided by the pension rebalance. That 1-2 combo led to a massive squeeze on the day that he announced his ceasefire, right? Or talks about the early parts of ceasefire. So you get that 1 + 1 + 1 = 100 type market reaction. And then similarly this week, right? It's been options expiry week. You had the VIX expiry yesterday. It was the biggest VIX expiry since COVID, right? Big hedges were in place for April, all had to come off the board. We saw that, just broad puts destruction and VIX call destruction just kind of led to, further levitation. And you're seeing it again into regular expiry tomorrow with the S&P expiry in the morning and single stock expiry in the afternoon. It's one of the biggest single stock calls expiries like that we've seen over the course of the last several years. So there has been a massive chase into tomorrow. It just makes it very difficult to get the fundamental data or the fundamental narrative to overwhelm those flows. But as we exit and we move into next week, the possibility that the actual economy and earnings and those fundamental factors can overwhelm the systematic flows and the option buyback as the gamma gets removed, it goes up. Doesn't mean we're going to crash on Monday. It just means we are more likely to trade an economic reality for a week or two, whether there's macro, where there's earnings, and that's going to matter. And until we get to the next month's expiry, when we have to deal with these supportive buyback flows again.
Yeah.
Yeah, but it's just like, and we talk about this on the show a bunch, and I talked to you, Craig, personally about it. Like, this was the largest decline in 30 delta implied correlations for the data I have on Bloomberg. So 20 years since we were in that 06 period where it felt 06, 07, I felt a lot like early 07, kind of like this, where you could sense something was building, but you weren't seeing it in risk. And, it's 55, 60% declines in the 10 delta, 30 delta. And if you look, this is the percentile of 10 delta. We went right back to the level we were at before Volmageddon in 17. And you guys remember 17, that was like the worst year ever for macro or guys like volatility like me. And we're right back there. It's kind of mind-boggling, right?
Oh, absolutely. I remember it was a few weeks ago. I think it actually may have been March 30th or 31st when my co-host Anthony was mentioning. He said, the NASDAQ was like 3 standard deviations below, the year-to-date VWAP. And, he's been trading. He's in the pit trader for 35 years. And he just remembers, he's like, we may keep going down, but we better get incrementally negative news at this point in order to keep us going down, because we are extremely oversold. And this was the day before this JP Morgan collar, right? We made that low or whatever it was on the 30th. And it's just a reminder, like we were so unwound the other way that when you got, that positioning just so one-sided, the snapback, when you add in, the gamma from the put strike collar on the 31st, then you get the pension rebalance flows, then you get some positive news from the president, which suppresses volatility even more. Then you get into options expiry, right? You've seen this put destruction and unwind. Then you get the short covering of hedge funds who are not exposed. And so what you've seen over the last 10 days is that the short indices are up twice as much as the regular indices, because most short baskets have outperformed. Hedge funds are covering shorts in order to get their nets up. And then you've had, then you have this chase for, or some FOMO chase into calls, particularly back into Mag 7 and AI related names, because for the first quarter it was out of those names and into energy. Well, if energy is going to start falling because the war is over, then we go back into the Mag 7 and stuff. So, and those are the biggest names that are in all these leverage ETF funds. And so you get massive rebalance every day, at the close for those flows. It's 1 + 1 + 1 + 1 equals 100. And you get this V-shaped bottom, which leads you to believe that the world is just going to completely look through any economic impact of what's gone on over the last 6 weeks. And as a human participant, it's very hard to sit there and just watch prices and say, this time is different, right? You're like, well, the price action is a price action. It must mean that things are better. But the reality is that the size of the structured product flows and the size of the zero data expiry option behavior and the size of the volatility selling is just so enormous, particularly in certain times of the month, that they just overwhelm anything and everything else that's going on. And so being a macro fundamental analyst just means absolutely nothing, much to the chagrin of the macro strategist at Ninja Trader Live. So, but, here we are. Expiry is tomorrow. And so that positioning comes off the board, and we'll have to deal with the reality next week of, is the ceasefire continuing or not? Are ships really starting to move? What are the companies starting to say? I was looking at the earnings this week. There's been, the banks have reported kind of mixed, not great. A couple of other names that have reported, TSM, great numbers, stock traded down. ASML, great numbers, stock traded down. Netflix is right now, looks like the stock was down earlier. I don't know if it's still down on good numbers. So, if earnings are beats and the reactions are poor, makes it harder for guys to hold on to those positions. If we push through the back half of this month into earnings season, then, I think it wouldn't surprise me if we started to trade the other side of this in the next couple of weeks, and people say, wait, why, what's different? Well, really nothing's different. The only thing that's different is that the supportive flows are gone. And I think that's the reality that we're about to push back into.
Yeah, and it looks like Netflix is down 11 points, so getting hit pretty good. I don't have any comment on that.
Just to rewind a second on this energy equity rotation. At some stage, the long dated barrels will start to feed into those energy equity multiples. I got a sense that we potentially have been given a bit of a gift here.
Yeah, I'm looking at just right now, like December 26 crude up at 77 and the high was 81, right? December 27 crude is 72, the high was 74, right? We're still very close to the highs on those deferred contracts than not. And what you're seeing now in the rig count in the US is nothing, right? You're not seeing any growth in the rig count. You're seeing US production still, is churning higher and exports are up, but there's no rush to bring rigs back on, despite the president saying, come buy our energy. We got plenty of it here. The US corporates are not going to rush to bring on any capacity at anytime soon. And so you're right. If we start to put through $75 plus energy crude into long dated models for big cap oil majors, when, whatever it was 3 months ago, people were thinking 55, 60. Well, we're talking about 20, 25, 30% uprating on multiples there. I agree with you. I think energy is going to be a place to continue to deploy capital into, over the course of the next weeks and months. Once we, once we kind of understand where things are going to settle out, and you still have the potential left tail event where this gets a little bit more squirrely, right? I mean, hopefully it doesn't for all involved, but if the Houthis decide to do some damage in the Red Sea, or if they start throwing flowing missiles again at refineries in Saudi, well, that's precarious for the rest of the risk assets, and energy will certainly outperform in that environment.
So I was searching for this before, but when I got up, didn't the White House call in a lot of energy chief executives today, or is that happening tomorrow?
I think there was a conference call or something that was.
Yeah, I mean,
yes.
There's lots of whispers and rumors around product export bans potentially, which would be an own goal as far as I'm concerned. But there hasn't been anything in the news on that today.
No, it doesn't seem like it. There definitely have been some calls going around. It seemed like the oil, the word out of the oil CEOs, not surprisingly, I guess, was, finish the job in Iran, which is the same message you're kind of getting from many of the GCC countries too, which is, finish the job. And Israel too is a finish the job type construct there too. The only one who really doesn't really want to necessarily finish, and by finish the job, I know it's, I'm being a little bit cavalier with my words here, but the U.S. is in the negative carry position here. Iran is in a positive carry position here. The longer the war goes on, the more likely that they will achieve whatever their end goals are. Israel is in a positive carry position because they would like to achieve the end of the Iranian regime. The GCC would like to see the end of the Iranian regime too, particularly after they've attacked many of their strategic assets. So the one who's really not taking this, to the finish line here is the president, because he is, sensitive to financial markets, and he's sensitive to the oil price. And, we'll see here. I mean, he's had the upper hand, but if that means that we're going to continue to have a nuclear Iran, and Iran's going to control, the Strait of Hormuz and that throttle, was that really a good outcome? I'm not so sure. So, we'll see. But I, kind of even just looking back historically, and maybe you guys have some more perspective on this too, but when has there really ever been such an ability to control the global economy like this before? There's just been very limited amounts of historical evidence that an economic entity has been able to really put a throttle on global trade and global economy. I mean, last I could think of is the oil embargoes back in the 70s, right? I mean, what other real example do we have of one country being able to really slow everything down for the global economy like this? It's been some time. And so I don't really think markets have properly ascertained what that actually means.
Yeah. I mean, ultimately sort of post WTO globalization is what atrophied sovereign resilience everywhere in the world. Right. And this is just the end point of that. So yeah, it doesn't have historical precedent.
Yeah, and I think risk assets are just kind of blasé about this whatever this environment is, and people are thinking, well, eventually this is going to open, the blockades are going to go away, and we're just going to go back to an environment that existed in February 28th, right? And the strait's going to be open, and there's going to be no tolls being paid, and all the ships are going to flow swimmingly, and everything is going to go. We're going to be kumbaya again. It just doesn't seem that's going to be the reality. It seems like Iran's going to continue to extract economic rent from Hormuz in some capacity, whether they're paid a toll in RMB or in gold or in crypto, whatever that is. And they're going to basically dictate who gets in, how fast things go. That's going to have implications for the supply chains everywhere for a very long period of time. It's going to have implications for the dollar. It's going to have implications for treasuries. Implications for gold. So it seems like we've only really scratched the surface of this, and no one's really thinking that the markets aren't really thinking that the world is going forward looks different than the world on February 28th. I tend to think it will be different.
Yeah, I agree. Well, let's talk about, you talk about implications for the dollar and treasuries. Let's go there. Sort of coming into this year, where were you in your head thinking around the direction of travel for the dollar and for rates?
Yeah, I mean, with respect to the dollar, I mean, the only real way to bring back manufacturing to the U.S. and to restore those jobs is through a significantly weaker dollar. I mean, there's really no other way to achieve that level of competitiveness. And I think the president and the secretary of the treasury were very much on board with that weak dollar environment. And you definitely saw, the dynamics in play there of what that meant, right? You saw finally the U.S. exceptionalism trade, start to subside on a relative basis. There was capital flowing out, moving into other areas, whether it be Europe and then Japan. Emerging markets were really strong to start the year as, people realized that their weights in U.S. assets were too high for, versus that reality. And I think everybody was kind of okay with that. I think the president was okay with that. I think the markets were generally happy with that environment. And so ultimately, I think that's where we will end up again, is a U.S. dollar that continues to come under pressure over time, because that's the only way to bring back manufacturing and these jobs. And if you would believe that that's what the president is trying to do, then that's I think that's a realistic goal.
The trouble is it's inconsistent with SPU's strength, right? Ultimately, when you take that wonderful sort of inbuilt hedge, which is that your Mag 7 stocks in euro terms were always gold, even in a sell-off. You take that, you take the sort of dollar strength hedge away from that, and then all of a sudden, in a hyper financialized economy, CEOs stop spending, they start laying people off to make the numbers, and that you've got that headwind working against you on the whole sort of manufacturing renaissance. Who's going to spend the money?
Yeah, look, I think there's hope from the administration and from, I guess, market participants that you can have this graceful rotation, right? What have we seen year to date? I mean, look, S&Ps are at the highs with software down 25% and energy up 25% or more, right? So we've seen, and software is, a much bigger sector than the energy sector was. And yet overall, if you own the S&P, you're kind of holding in there. So I think that the dynamic here is we will continue to try to build out the AI CapEx story, and the government is clearly supportive of that. And that, in order to build that out, we need more energy, we need more infrastructure, we need more materials, we need more utility CapEx, we need more uranium, we need everything that goes into that build out. And we will somehow be able to, gracefully shift the market cap from being so tech heavy to a more balanced sector composition of the S&P. And if we don't get tremendous labor displacement, and this is a big if, obviously, and I kind of don't believe this will be the case, but as long as we don't get tremendous labor displacement, then you won't have the passive flows dissipating, right? You'll continue to get money that just only goes into buying equities. And now I know the flows are small, but the Trump accounts, right? Like every kid's going to put money into the stock market every year, and there's going to be tax advantages to put more money into the stock market. I just got my, automatic put into, I've been at Ninja for only a few months now. I'm finally eligible for the 401k plan. I just learned that I actually have to opt out of the plan in order to not put money into the plan. They automatically put the money in. You have to sign a form that says you don't want to opt in. So there is clearly, a broad effort to just continue to put money passively into the U.S. stock market. And as long as those flows come in, I mean, Mike Green's obviously the expert at that. It's hard to break that psyche down. And so we can have violent dispersion, big sectors outperforming, big sectors underperforming. But we just kind of keep grinding higher here, in line with, modest multiple expansion, a little bit of rate cutting, earnings chopping along. And that's that's your holy grail, I think, for the president, right? That is, bond yields never really move materially higher. There's no risk of, deficit spending really blowing out. Manufacturing does better. Investments from GCC continue to come in. And this is the hottest economy that, anywhere in the world, as Trump likes to say. I'm obviously have some being a little facetious, but I think that was the hope. That's the goal. The reality is, the polling is terrible. They're going to get destroyed in the midterms, and the second 2 years of this administration are going to be lost are going to be lost because we're going to be mired in impeachment hearings. So, and I think when you look at the second year, the midterm year, there's some seasonal pattern there. you typically get a pretty decent sell-off between, May and the midterms, when the president is definitely going to be losing seats and may lose control of both houses. That just seems like a really crappy setup for risk here, as we push through the summer.
Yeah, and
not to mention we've got a few $100 billion worth of concept IPO paper to absorb as well.
Yeah. I mean, go ahead, Craig. Sorry.
No, I was just going to say, I mean, that money needs to get raised. It needs to come from somewhere. Like SpaceX is still, we can argue about what the valuation is, but they're still going to raise try to raise $100 billion, right? The money's got to come from somewhere. Anthropic's they're going to raise money. OpenAI, they're going to try to raise money. It's got to come from somewhere.
We did a whole show on that liquidity vacuum a few weeks ago, and I mean, no one's answered the question to me. I don't understand. Even if the rules have been rigged such that they can tip 40% of the deal straight into the triple Qs and other passive vehicles, I don't see, as a former capital markets banker, where the other 40 billion is coming from. Right? This is a $115 billion IPO, including the green shoe, if you take Musk at his word.
Yeah, I mean, it's not eligible. It wouldn't even be eligible for the S&P inclusion for quite some time, and it would have to be profitable in order to do that. But maybe the Nasdaq can make some exceptions sooner for the Nasdaq. But still, you're right. I mean, it's going to take time. The money needs to come from somewhere. I mean, you can assume, I guess, banks will help keep the leverage afloat, and maybe we'll get some of that cash off the sideline nonsense. But not to mention, globally, the call on capital is rising, right? The AI CapEx needs to get built. The deficit spending is going up globally. Now with military spending needing to go up everywhere too, Japan and Europe and China's, are already deficit spending. And then you're going to have to add on reconstruction spending for all, the areas that are been destroyed by this war. I mean, I remember it wasn't that long ago that the GCC was going to be investing trillions of dollars into the U.S. economy. Well, I mean, it sounds like they're going to need to be investing at least some money back into restoring some of their infrastructure assets that have been destroyed by the war here. And are they going to be so quick to, give us that money when we didn't really necessarily do the greatest job defending them? We'll see. I mean, that's a topic for, it's a big boy, seat at the table type topic. But yeah, there's a huge call on capital here. It's increasingly going to need to be debt financed. Cost of capital is rising. We've already seen that with the AI CapEx. It's gone from being internally generated free cash flow to being borrowed. So debt investors typically want to get compensated. Costs are going to be going up everywhere. Deficits are going to be spending. It's going to put some more pressure on equity multiples, broadly speaking. That typically is a headwind for risk.
Yeah, I mean, supply is usually what ends these things, right? So yeah, let's look at, I'm going to come back to this rally. It's been a lot of stats that have come out. It's like the only time we've corrected from 10% to an all-time high since 1928. From 9% the last time was 2000s as the only observation. Seeing this weak breath, what do you like? Do you view it as something of weakness? Because we've seen these rallies before, but usually it's like after Liberation Day, or it's after COVID, or it's after. We didn't really see that much destruction outside of a few sectors, and a lot of that happened prior to last month, to be honest, right? Like private credit and software and crypto, like that stuff really got going from July through some starting October till recently. So I mean, I don't know, as a guy who lived through 2007, these things are processes. And I remember people losing their mind in 2007 when it was like obvious, and then people just like got fatigued by it,
Yeah. I think we started the year where there was hope for the breadth expansion story, that we were going to shift out of Mag 7 and AI into a broader economy. And there was hope that I guess the AI CapEx build out was going to take us keep the economy humming at whatever the number 3-4% real GDP, and that was going to lead to a broadening out rally. When you combine that with the likelihood that the Fed was going to be cutting, because this wasn't going to be inflationary, because the AI boom is, productivity enhancing, and we're not going to have inflation, right? You started to romance the idea of this breadth, expansion, but really, under the hood, I think what we've seen is that the housing market really hasn't gotten better. Commercial real estate really hasn't gotten better. The low end consumer really wasn't good, and now is worse because of the higher energy prices. And so, the private credit story, which started in the fall becoming an issue, now seems to be an even bigger issue. Yields are now higher. Oil is now higher than it was at the beginning of March. Seems like there's more headwind and more reason to be concerned today than there was 6 weeks ago. And I think what we're seeing with the breadth narrowing is just this dynamic of the systematic flows and how important, the S&P and S&P structured products and zero data expiry trading on S&P matters. And so much capital is so myopically involved in that narrow index. I mean, we talked about this, like you can't use the S&P to hedge a portfolio anymore. And so all we've really seen, let's say over the course of the last few weeks, is this dynamic of the vol selling, reloading up of calls, covering of shorts, and it's been a highly correlated move back to the upside here. But the movement out of energy and back into big tech is really what's propelled us, the indices to the highs. And we're starting to chop off, other parts of the economy again, right? And so energy is not making highs. Staples are not making highs. Man, the consumer discretionary names can't make highs. And so I think that's the breadth deterioration is coming back in here. And I suspect that's typically what you see at the end of cycles is the kind of the last hope into.
I have a chart for that, but just real quick, I have this up here. I mean, what do you make? The Squirrel doesn't believe in sentiment indexes. He thinks that it's all been polluted by politics. What do you think? We're at the 75-year low in the consumer sentiment, yet the P for the market is 25.5 times trailing, sitting near, historical bubble levels. Is that, I mean, it's pretty much as disconnected as it's ever been almost.
Yeah, you have this Main Street versus Wall Street narrative dynamic in society, right? Where the president and the administration tout the strongest economy of all time and the S&P at 7,000. And then you have sentiment readings that are at generational lows. There's clearly a disconnect here between, what's going on. I think that's showing up in the polling data for sure. But as far as the markets are concerned, when you have these large cap tech names that are still generating strong earnings growth, it's hard to break that multiple down. And the other thing is we haven't seen yet the labor story, destruction, right? I think that's coming. I mean, if AI is as good as the multiples on big tech suggested is, that means the displacement that's coming for the white collar sector is going to be way higher than what is being currently priced into markets. It's probably more likely to come out as Dario from Anthropic believes than not. I mean, I know he's talking for, anywhere between 10 and 50% white collar displacement. That's a double digit, unemployment environment in 18 months from now, right? Like certainly we're not pricing anything that resembles anything close to that, but in order to generate the types of multiples we're seeing on big cap tech, you kind of have to have it one way or the other. If you believe that's the growth, well, the labor displacement's got to be coming on the back of it because the productivity enhancements are so good that we just don't need, humans anymore in many of these jobs. And corporate America is going to wind up cutting in order to preserve margins.
Yeah, I read a paper and I sent it around to a bunch of people called the AI layoff trap this week. And, the reality is that complex adaptive systems work such that the optimal strategy for an individual agent is suboptimal for the field, for the society, right? It's kind of like, the squirrel leans left because he's thinking about other people, not necessarily just what's for him. So these companies, basically, it makes sense because they're only going to take a fraction of the demand hit from this, right? But they get all the cost savings. And so if everyone pursues the same, race to the bottom type strategy, but, this chart, I was on the phone with Mike Green last night and he sent me this. I love this chart. And as the bond bull here, I like it a lot. But we're having labor force growth decelerate. And I just don't see how that doesn't lead to amplified by what you were just talking about with the AI stuff and deleveraging, till the housing market doesn't get going. That's been one of the ways to boost the economy. I mean, how are we going to grow the economy? Like, how are it'll be a good stock pickers market, but the problem with that is then things get crowded. Like right now, all the guys who are beneficiaries of the capex, like they trade at insane levels, right? So you have the crisis of crowding. It's a weird dynamic.
Yeah.
And what do you think? Like, what is it that like plays this out? Like, is there an aha moment, or is it a slow bleed, or is it, hey, we'll do what we did in COVID, which is we got the pricing growth, so the earnings growth was there because we didn't have to pay the people yet, and then it lagged. Whereas here will be the opposite, right? Where you have the demand lag, right? So you get the cost cuts first, but the demand will continuously disappoint, in essence, at an aggregate level.
Yeah, it's like every time you hear that Anthropic has gone into a new sector, like that subsector, those stocks just get absolutely destroyed, right? Because the assumption is that the pricing power of that sub industry basically goes to zero because Anthropic charges nothing in order to create that product. And so it seems like we're going to just have the top line degradation, the pricing declines are going to be, they're more than offset any of the benefit from cutting labor in order to preserve margins. And so I think companies are going to try to lay people off and hold the line on price until the AI comes in and just destroys the price, right? Because we're not talking about pricing going down, 2 to 3 to 5%. We're talking about prices getting cut in half, or prices getting cut by 75%. Like you can't fire enough people in order to offset a 50% decline in the pricing because Anthropic came and destroyed your economic moat. So I think what's going to wind up happening is you're going to start to get, we're going to start to get layoffs, right? I think we are going to get layoffs, and we're going to get a potential Fed reaction to that, and it will be no benefit. There'll be no benefit from cutting rates, right? The Fed will say the labor market is starting to slow. We could start resuming our cutting cycle, and there will be no benefit to a 25, a 50, 100 basis point cut in rates because that's not going to lead to any more employment, right? This is a structural factor, and the idea that I'm not trying to be a Luddite per se, but the idea of kind of societal bulls is that, well, we've always figured out a way. We always find new jobs. We can't envision them now, but they always are there. The thing I think that is a bit different, or the thing that's necessary to understand, is that there is a timing mismatch between that, right? We lose a lot of jobs first before we get new industries and get new jobs. And the problem with that in a society that is as levered as we are right now, 130 whatever percent debt to GDP and running 5, 6, 7% deficits annually, is we can have a huge crisis before we could buy our time to get to that future where there is more employment. So that is the issue, right? If white collar workers are the ones that are getting displaced, well, the white collar worker is the backbone of the banking industry, right? White collar workers own all the mortgages, they have all the credit card debt. If they start to lose their jobs, they're going to cut back massively on spending, selling their homes, and so. When have we really gone through this kind of white collar labor displacement before, as levered of a society, as levered of a banking system as we have right now? I can't really think of a prior episode. Maybe there has been one, but it seems precarious from that front. And when you combine that with resource nationalism, needing to build out supply chains globally, duplicative supply chains, adversarial relationships with big commodity exporters or big product exporters like Russia, like Iran, like China, it seems like we're, crescendoing to something that looks a lot worse for risk assets and risk asset pricing than looks better, 6 to 18 months out.
Yeah. I mean, I guess it comes back to that 07 thing. You see the log periodic oscillators getting more and more. If I go back actually, let me go back. I can kind of show you that. If you go back to that chart I had with the deltas, right there, you see how in a normal regime, this is like the 30 and 10 deltas. It's just kind of like that. And then we moved into this new regime, and you're seeing these. So it's the percentage 12-day growth spiking up. And that's what you see as you approach what, Sorrent calls a dragon king, which you do think of as like one of these statistical outliers in how that don't follow power laws. And I just feel like it's hard because we're all slaves to high frequency data. So if you, to your point about Trump, if you keep the S&P so it's not too much drawdowns, if you have a drawdown, you get it back up, people don't worry about it. But like if it's all built on leverage and coupling increases, because again, the correlations are just at this historic low level. If we go back to a different regime, this market has a 0% chance of holding up.
Right.
And
the other thing too is you don't exactly know where or which economic actor is going to cry uncle first. It's not going to be the S&P trader, but maybe it's Japan can't get LNG for a period, or Australia runs out of commodity product because the refinery's out, and now all of a sudden you're looking and there's gas shortages, and Europe runs out of jet fuel, right? There are places where the war and the shutdown are going to matter first, and those are going to be the pinch points. And what do those economic actors then do in order to navigate that situation? Because that will lead to the follow-on effect, right? If Japan or Korea or Europe is forced into a situation where they have to sell US dollar assets in order to raise dollars to buy more expensive energy, then the US bond market starts to sell off, commensurate with Boone selling off and JGB selling off. And then you start to get more highly correlated, risk asset dysfunction, right? So, right now the US is in a relatively good situation because we have an energy export position. We have cheap natural gas. And so our companies can make, outsized margins by trading against global producers who have to buy expensive LNG, right? A US petrochemical company competing against a Japanese one now, massive potential for relative market share gains there because gas is so cheap. But eventually there'll be bankruptcies in Japan, or there'll be bankruptcies in Europe, and there'll be shortages in these countries. And so we don't exactly know where the fault line is, or look, maybe it'll be in the GCC where, one of these pegs will break because the deficits are expanding, so rapidly. And eventually, one of the GCC said, like this dollar peg, like not really working for us. I don't know exactly, but there's plenty of economic fault lines that exist around and those will be places we need to watch, because once one of them really starts to go, it'll lead to the next one and the next one. And then we'll have a well correlated, multi-standard deviation move where risk asset prices really get face planted because of all this leverage. And so the Trump tacos will finally get overwhelmed by the economic reality of a highly levered financial system that breaks somewhere else first.
Yeah, and I guess let's go back to your playbook. As we come closer to the hour, so is this kind of what you're thinking? And let me ask you one other thing. What do you think about eggs here? The Squirrel has written a piece, and we had a guy named Nico Hoyt on there making the case for eggs. And I just literally had a message from a guy who said, that Sri Lanka headline we had, they just got hit by a hurricane, their tourism's tanked, cotton, right? Like, I think that the models, what I understood from Nico is the models for that stuff are not nearly as sophisticated as you think they are, because data gets protected pretty well. I mean, we've talked about the energy stuff. What do you think about the eggs?
Yeah, I would probably throw ags in that bucket of length, right? The cycles just take a little bit longer. We know the weather really can dictate whether or not a crop gets made or not. And it's hard to predict that. But look, with fertilizer prices,
what's changed is that
fertilizer, right? So look, with fertilizer prices as high as they are right now, the likelihood that farmers are going to apply, as much fertilizer as is needed is lower, which means the probability that yields are going to be as high as needed is lower. And so, it takes a little bit longer to have that play out. And, you have to deal with the weather risk, through. We can have a perfect, growing season in North America. And all of a sudden we get massive, corn and soybean yields. And this trade goes, it gets pushed out a year. But, the probability that we're going to have perfect weather, is not perfect. And if we have less fertilizer, that means we need an even higher probability to have perfect weather. So I think you could play that out over time. I think ags are part of that, or, a part of that story, and need to be, part of a portfolio of commodities, right? I mean, there's, the allocation of global portfolios to the ags are basically zero. So having, 1% is probably, more than anybody else has is probably, enough. So whether that's, long dated corn or even playing through some of the fertilizer equities. I think we were talking beforehand about sugar. I mean, pick your, find your expertise, find folks who know these sub industries, better than not, and glom on. But yeah, I think there needs to be allocation into food too, because we're just in a season. I saw the urea tenders over $1,000 a ton. Farmers can't make any money, with corn where it is and fertilizer and urea at $1,000 a ton. It's not possible, which means farmers are going to go out of business, or they're going to tax the government, meaning they're going to ask for subsidies and bailouts and more money printing in order to keep the farming lobby happy. And that's, going to be deficit expanding. And that's where on the right side of this chart, I struggle with the long end. I have no real love for the 30-year. I can understand why, the Fed may cut, and why you'd want to own maybe the belly, but I struggle with, 30-year. Really I guess the bull case for 30s would be that Besant realizes this too, and he just decides to stop issuing them, which is possible. I mean, I think if he does, and we just start to, or increasingly do what he criticized Yellen for doing, which is financing the government at the front end and bills, well, then the dollar is going to be the outlet there, right? We'll continue to see a weak dollar. That'll help precious metals. That'll help gold. So I think, it's a little bit virtuous here. We need to, if the government doesn't want to see long end yields move materially higher, they will increasingly look to finance themselves from the front end. They will try to debase the dollar further, but doing that is also inflationary. So eventually they're going to have to choose, right? Same with Japan, right? Eventually they're either going to choose the currency or the bond market. Right now they've kind of been playing, allowing both to weaken kind of together. But, we'll see at some point, typically it's yields that get protected and the currency gets debased. That's usually how this goes. I suspect that's how it'll go there. I suspect that'll how it will go here. And so, I still own a fair bit of gold, and I think the sideways consolidation that we've seen here over the course of the last several weeks, when you would have thought gold would have done better, I think is a tremendous buying opportunity. So looking to continue to accumulate gold over the course of the next weeks and months for much larger prices in the future.
Just on that, I mean, I think what we've seen is, a lot of gold getting sold by sort of sovereign-like entities recently because we've had the rainy day, right? Where this is why they own their gold, because something like this comes along. The question is that back to your Hormuz choke point issue, and we're not through it yet. That does imply that there's a bit more raiding of the rainy day savings that could be ahead of us. Yeah, I tend to agree with you longer term. This is probably going to look like a great entry point, but I just don't think people are done raiding their savings yet.
Yeah, and look, part of the savings plan of Japan and Korea and Europe is treasuries too. So, yes, guys like Turkey who are most exposed, who don't own a lot of treasuries, own a lot of gold, I think have, been part of the gold selling story first. But as the strait continues to be closed and other folks are more exposed, those are the large treasury holders. And so I think you get into that dynamic where their selling of treasuries becomes a bigger problem for the Trump administration, who will then look for more sustainable solutions to getting the strait reopened, whether that be a full-fledged military attack or just relinquishing control to Iran and letting the toll system play out. And so I think we're getting closer to that, right? I mean, I think we've seen this recovery, some complacency get back, has gotten back into the markets. People are looking at the reaction of stocks and saying, all right, I guess it's all clear. And what I'm saying is I think a lot of this reaction has been highly mechanical, structured flow driven, expiry driven, and the realities of keeping the strait closed for 6 weeks and likely continuing to keep it closed or throttled for the next several weeks, if not longer, means the economic realities are ahead of us. They're not priced in. Equities are no longer the most forward-looking indicator and are really looking through. Equities are just looking at the present, actually, And eventually, when they start to look through, they're going to see a more precarious future of slower growth, higher inflation, margin degradation, a weakened consumer, and the AI stuff. I think is bad before it's good. It's labor displacing before it's massively deflationary, where everybody gets everything for free, and we live into some utopia where you don't actually need money in order to survive. So that's a dour outlook. But after whatever it's been, a 2,500 point rally in the Nasdaq over the last few weeks, I feel a little bit more comfortable that being negative than not. So.
Thanks for cheering me up, Craig. No, I think, with markets, we just sort of this last sort of 2 or 3 sessions is where, my sort of smugness, having degrossed so aggressively in February, is now coming back. It's like, this is the pain point now. We're back to levels where we sold.
Yeah, I mean, we're starting to see.
I have to say, I find myself increasingly in your camp. I've been on a buyer's strike for several weeks now. But it's fun. It's fun making shopping lists.
Yeah, for sure. Look, and I think we're starting to see the idiocy that happens at the end of these moves, right? Whether it's Bird earlier this week, the shoe company that became an AI company. Look at Avis. I mean, Avis, 55, whatever it is, 50% short interest. Stock is up, I don't even know, 250% this year. Massive short squeeze going on. You could see, right? This is the, stuff that kind of happens when hedge funds with lazy positioning are just getting run over, and they're just being forced to cover. Like, I mean, when was Volkswagen, right? It was like in the middle of 2007, or for early part of 08. So these are, when we get these short squeezes like this, I typically find that we're closer to the end of moves than we are at the beginning of these types of moves. And so, we'll see. But having something like Avis and something like Bird happen on the same week, I feel like we're closer to the end of this counter trend bounce, and we'll start to trade, the phase 3 down move of the economic reality over the course of the next weeks and months.
Cool.
All right.
Well, listen, Craig. Go on, Benny. Go on. What you say?
No, yeah, I was just gonna say, it's one of those things where it's such a weird time because guys like us, kind of dinosaur-esque guys, see, they look at things that are more based in fundamentals and reality, and we're all cognizant of the market structure stuff, but most people just care about returns, right? And so it's difficult because in March, like the Squirrel said, it felt good to have sold early and been in front of it, but now you're back here. How do you think people should deal with this? It's a difficult situation to be just an average investor, I think.
Yeah. I mean, look, I think when you get times like, well, let's even step back. There's always things, and I hate to use the Kramer line, but there's always a bull market somewhere, right? So I think what you do is you try to find the multi-quarter stories where earnings growth expectations is accelerating, where numbers are going to continue to move higher, and you shift your portfolio into those assets. And then when you see volatility getting, demolished like it is or has been over the course of the last several days, you use that as the opportunity to put, hedges in your portfolio, whether it be, specific hedges in the sectors that you're long, or even, to some degree back into index hedges. And then when you get volatility that is elevated again, and you get these moves where we're 3 standard deviations away from the year-to-date VWAP, you say, okay, let's monetize those hedges, right? And so it just kind of gives you the ability to, look through that volatility. I think that's really the only way, unless you're going to sit here and stare at the screen every single minute of every day and wait for and even that's not very efficient when you're competing with LLMs and high frequency trading and quants and algos. You're not winning that game either. So you're better off thematically finding the places to deploy capital over the next quarters. And then, having a screener in place that says, okay, what did volatility do? What did the VVIX do? What's correlation doing? And when you get to the lower bands on, like you showed that 10-day, implied correlation charts back down to the lows again, right? The vol is back down to the lows again. I mean, so the call buying, is back in the 99th percentile again. So we're getting to those extremes again on the overbought signals. If you've caught this rally, great, put some hedges on. And if you didn't, okay, this isn't the time to go and try to plow into risk. Wait for wait for these signals to play out and then deploy back the capital again, because I think we're still at early stages of this rotation from paper to hard assets. I don't really get the sense that, yes, that trade worked to some degree in the back half of last year and the early part of this year, but market cap weighting is, suggests that we're still very much in the early stages of that game.
That might be it. That might be the answer, commodities and long correlation. Long correlation looks pretty good right here. I'm not going to lie. Yeah. Like that looks like a real trade.
Yeah.
To be honest, it's looked pretty good for a couple of years.
Yeah, but I mean, again, you look at us at the lows, back at the lows, it's attractive again, so just trade it then. If you don't have to play for it to go back to 70.
Yeah. Anyway, Craig, why don't you tell everyone where you can learn more about Craig Shapiro and more about NinjaTrader?
Yeah, NinjaTrader is the largest futures broker in the country for retail traders. We're owned by Kraken. We host a YouTube channel where I'm live 4 days a week in the morning on a macro panel with Shy Girl and Anthony Crudelli. And throughout the course of the day, we have traders who are trading futures markets, so live streaming what they're doing. I also host a market prep show on Sunday afternoons at 6 o'clock for the Sunday Open. And I write on Substack, and increasingly we're going to start to put out more written research content for NinjaTrader subscribers. And so you can find me on X mixing it up with guys like you and Ben and whoever else wants to mix it up. And my handle is CES921, which are my initials. So thanks for having me, guys. Really appreciate it.
All the LLMs now. I feel like it's like tough to get through there. The LLM content.
It is hard. It is hard to do, but I try to put the memes. I try to do a lot of memes also, so it kind of keeps keep it light. So
memes are the best.
Well, listen, Craig, it was really great to see you again, and thanks for joining us. And we'll catch you next time. So, Craig, Benny, and the Squirrel out.